I know I'm gonna get a lot of pushback for saying this, but I do not think Tesla is a great investment right now. And in this video, I wanna explain why. There is no question about it, Tesla is a great company. They have a great story, awesome cars, a big, audacious mission to fight climate change, and a really visionary CEO. But that's just it. Tesla is a great story stock, and Tesla, despite being one of the most popular stocks in the world among retail investors, most of the people who own it have probably never looked at a single financial statement. In fact, did you know that Tesla only recently became profitable? Before 2020, Tesla was a very young growth company that was borrowing a lot of money in order to grow and become profitable. So they financed a lot of its growth with debt, and for a while it was pretty risky. It just wasn't sure if this company would pan out. Most recently, the company did post a profit, and they will probably continue to do so. So I think this company is out of the high risk, high debt territory. But still, this is the sort of thing that's important to understand before you invest in a company. Now, I'm fully aware that Tesla has some big name supporters, such as Cathie Wood, who's the superstar fund manager of Ark Invest. And for those of you who don't know, Ark Invest is one of the hottest funds right now, and they specialize in disruptive innovation. Recently, Ark announced that they're targeting a stock price of $3,000 a share for Tesla by 2025. Just to give you a reference point, as of today, Tesla was trading at around $640 a share. So $640 to $3,000 by 2025 is what they're projecting. The cool thing is Ark Invest actually published their valuation model for the entire public to see. So as a huge fan of Cathie Wood, I took the time to comb through her Tesla valuation model. Now, don't get me wrong, I would love to see Tesla take over the world. That way we can reverse climate change and save the planet. I just love visionaries like Elon Musk, and no question about it, if I were to buy a car, it would definitely be a Tesla. However, as I was looking through the model, I found myself questioning a lot of the assumptions. I think that Ark's estimates and assumptions they made to get to that price estimate of $3,000 by 2025 is a little too optimistic, and I want to explain why. In this video, I'm going to walk you through 2 reasons why I think Ark's $3,000 price target is too optimistic, and what I think might be a more reasonable price target for Tesla instead. Also, I know there's a lot of die-hard Tesla fans out there, so if you think my opinions are stupid, that is totally fine. We're all entitled to our own opinions, and you're welcome to share them in the comments. I just ask that if you have some criticism to share, please make it constructive and to put at least as much thought into your opinion as I have. So with that out of the way, let's get started. Okay, so 2 reasons why I think Ark's $3,000 price target by 2025 is too optimistic. Basically, it comes down to not factoring in what it will take to grow. When Ark came up with their $3,000 projected stock price by 2025, they forecasted a lot of growth over the next 5 years. Tesla produced 509,000 cars in 2020, and Ark is estimating that in 2025, Tesla will be producing 10.6 million cars. That's a 21 times increase in 5 years. Well, actually more like 4 years now, because we're in 2021. So that's, in other words, an 84% increase in production capacity per year. While I have no doubt that Elon Musk will pull that off, I mean, come on, the guy launched a rocket ship into outer space. So I'm sure he'll be able to do it, but growth doesn't happen for free, right? The more growth you want to create, the more you have to invest. You don't just go from producing 509,000 cars to 10.6 million cars without investing a ton into expanding new factories, getting more equipment, etc. So usually high growth companies like Tesla come up with this money in 2 ways. They'll either borrow a lot of money, which they have done and are doing, and or they will issue more shares of ownership in the company. Since Tesla already has a lot of debt, they're probably going to have to issue more shares at some point. In fact, the company specifically states in their annual report, which they published in February, that our business and our future plans for expansion are capital intensive, and we may need or want to raise additional funds through the issuance of equity. Problem is, whenever a company issues more shares, it's great because they can come up with the money to invest in growth, but this causes something called dilution. Dilution is when your piece of the pie gets smaller because there are more people to share the pie with. Just think of a pumpkin pie. I love pumpkin pie, by the way, even though it's not Thanksgiving. So if there's 2 people sharing it, you each get half of the pie. But if 2 more people join in the room, now there's 4 people sharing it, so now you only get 1/4 of the pie. So even though you still own 1 slice, that slice has gotten a lot smaller, and therefore it's not worth as much. So if Tesla issues more shares of ownership in the company, that's exactly what would happen to the value of each share. In other words, if you own 1 share of Tesla now, if they issue more equity down the future, each share will be worth less because it'll be a smaller piece of the pie. However, in Ark's valuation model, they're predicting that the number of shares in the company would only increase by 4 million between now and 2025. As of now, if all employees in Tesla converted their stock options and all convertible notes were converted to shares, that would already dilute the number of shares by 150 million. Not 4 million, 150 million. And that's not counting the dilution that would happen if Tesla issues more shares to raise capital, which I think they will based on how much they want to grow. So in my opinion, this is one thing that makes the $3,000 price forecast a little too optimistic. Then again, I have a lot of respect for Ark and their thought process, so maybe I'm just missing something here. Another factor that I think makes the price target too optimistic is the number of new industries that Ark is predicting that Tesla will successfully dominate by 2025. So if all goes as they've planned, by 2025, Tesla would go from being mainly an electric vehicle maker to also being a category killer in the car insurance industry and the fully autonomous ride-sharing industry. So at the moment, Tesla's insurance business is pretty much non-existent. They have some insurance offerings in California, but that's it. So with Tesla Insurance, in the bear case scenario, Ark is estimating that Tesla's insurance business will generate $23 billion in revenue by 2025. But according to IBIS World, the car insurance industry as a whole currently generates $311 billion in revenue per year. That means in 5 years, Tesla would go from 0 to almost 8% market share in a highly competitive, regulated, and capital-intensive industry. It's definitely within the realm of possibility. Again, it's Elon Musk we're talking about here. But the fact that that's what Ark estimates as their bear case scenario, as in the worst case scenario, that's what seems a little too optimistic. Then there is the rideshare business. In the bull case scenario, Ark is estimating that Tesla will have a fully self-driving rideshare service by 2025. In other words, that would be like an Uber service, but with all self-driving cars, so no human drivers. And they're saying that this division could account for 83% of the company's value. At the moment, Tesla is officially at level 2 autonomous driving, which means that cars can drive themselves only with someone supervising at the wheel. There's a level 3, level 4, and a level 5. I don't know all the nuances of each level, but basically for cars to be fully self-driving with no human involvement, they would have to get to level 5 technology. So for Ark's projections to play out, Tesla would need to get to level 5 in fully autonomous driving within 5 years and build out a ride-sharing service that is much bigger than what Uber currently has. Even with all the things Tesla has in its favor, which is a lot, it's just hard to believe that within 5 years, the company will be, and actually it's not even within 5 years, it's more like within 4 years, that this company will be dominating these 2 huge industries that it has no experience in. So those are my reasons why I think Ark's estimate of $3,000 is a little too optimistic, but hey, I'm a huge fan of Tesla and I would love to be proven wrong. And also a huge thank you to Ark Invest for releasing your valuation model and for sparking this kind of interesting debate and for being so open. Also, if you're still with me and you like the way I analyze things, I wanted to take a moment to invite you to my upcoming workshop, How to Build a Winning Stock Watch List. This is a 2.5-hour deep dive workshop where I teach you step by step how to research and pick out individual stocks and to do it all quickly and efficiently. If you've ever wanted to learn how to look at a stock price and just tell whether it's a good investment or not, then you'll definitely want to check out this workshop. There will be lots of actionable step-by-step information, spreadsheets, tools, resources, way more than I can share in any one YouTube video. So if you're serious about learning how to evaluate stocks, then definitely go check it out. Just go to rosehan.com/stockworkshop to find out all the details. And now let's talk about what might be a fair target buy price for Tesla if you were to invest in this company. Wall Street analysts are predicting 38% annual growth in earnings over the next 5 years for Tesla. So that's a 38% growth in profits over the next 5 years. So let's do some math here. Given Tesla's most recently reported earnings of 64 cents per share, that means with a 38% growth rate, Tesla could have earnings per share of $3.20 in 5 years. As in the day I'm making this video, Tesla stock is trading at around $640. So if you think of stock prices as a multiple of earnings, that means that right now Tesla is trading at about 1,000 times earnings, because earnings of 64 cents per share times 1,000 gives you the current stock price of $640. So in other words, Tesla currently has a price to earnings ratio, or PE ratio, of 1,000. Another way to think about PE ratios is what you are paying for every dollar of earnings. With a PE ratio of 1,000, I'm basically paying $1,000 for every dollar of earnings. With a PE ratio of say 20, then I'm paying $20 for every dollar of earnings. Obviously, I'd rather pay as little as possible for something, but get a lot back in return. So the lower the PE ratio, the better, because it means I'm getting more bang for the buck. So a PE ratio of 1,000 is very, very high. Now, it is typical for high growth, industry disrupting, innovative companies like Tesla to have really high PE ratios. So a PE ratio of 1,000 is high, but for example, back in 2013, Amazon had a PE ratio of over 1,400. So that's in 2013, when Amazon was still in high growth mode and before it became what it is today. But as you can see, even Amazon's PE ratio dropped in the following years, and now it's currently at 73.5. So all this to say, a 1,000 PE ratio seems justifiable now, given all the growth that might happen, but it's probably not going to be justifiable 5 years from now. I'd say as a stretch, a PE ratio of maybe 200 might be justifiable in 5 years. So if analysts' growth estimates are correct and Tesla grows its earnings per share from 64 cents a share to $3.20 a share, and in 5 years the PE ratio is 200, then the estimated stock price in 5 years would be $640.63. But wait a minute, isn't that what Tesla's stock price is right now? That's exactly my point. If we're estimating $640 in 5 years, but Tesla is currently trading at $640 right now, that means that the current stock price already has all the future growth potential baked into it. The stock has gone up so much that it pretty much reflects the maximum level of optimism for Tesla's future. So to me, at this price, Tesla isn't really a bargain. Now, if the current stock price were more like 400 or something, that would make it more attractive for sure. I just like to have a margin of safety when I invest, and it feels like current valuations have priced in zero room for error or hiccups along the way. In my opinion, for whatever that's worth, Tesla has gone up so much mainly due to retail investor speculation and the fact that it recently became part of the S&P 500 index, which obviously means all these passively managed funds have to buy the stock. And it's also pretty telling to me that other than Ark Invest, there aren't that many big name actively managed funds, especially those with a value investing mindset, that have bought heavily into Tesla. Also, I literally just thought of this, but what if self-driving cars becomes such a thing, like it just really does take over the world, that nobody wants to buy cars anymore? It already sucks owning a car. It's so expensive and they're mostly just gonna sit in the parking garage idle for most of the day. So if self-driving cars become so successful, wouldn't that actually make vehicle ownership obsolete? And then wouldn't that actually cannibalize Tesla's electric vehicle business? I don't know. I just thought of that. I know the world's gonna look very different in the next few years, and there is a lot of change and disruption going on. So maybe I'm just not being optimistic enough. Even though Tesla has a great growth story and they're so disruptive and they're, have a bright future in front of them, just keep in mind that the company just recently became profitable, and just barely at that. So to me, investing in Tesla right now is a little too much like venture capital investing and just too speculative for my taste. That's not to say that you shouldn't buy them, because you can make a ton of money doing it. It's just not my style. For now, I'm perfectly happy watching other people ride the Tesla roller coaster and maybe even become Tesla millionaires because they saw something that I don't see. And like I said, I would love to be proven wrong. So that's it for this video. If you like my approach to stocks and want to take this even further, Don't forget to check out my upcoming workshop, How to Build a Winning Stock Watch List. Just go to rosehan.com/stock workshop, or the link is below, because you won't want to miss out. And at the very least, subscribe to my channel because I post new videos every week about making, saving, and investing money. Thank you so much for watching. I will see you next week, same time, same place. Bye.